Okay.
Good morning, everybody. Excuse us for the tardiness. Facebook, of course, no matter how much you prepare, there's always got to be some kind of technical problems. But we're here, and like I said, happy Friday. Today we have someone new, a new partner joining us. Her name is Marisol Cortez. Hi, Marisol.
Good morning.
So Marisol has been with us for 5 years. You may recognize her if you've been to any of our branches or express service offices, as she has spent time in the branches with many of our members. In addition, you may recognize her because she's probably funded half of our mortgage loans here. So if you have questions, she's the one to go to. But today, she will be going over understanding credit and all the ins and outs and how you can improve it. She is technically our premier banking officer, so she's the one to speak to. So at this point, Marisol, I'm going to go ahead and hand it over to you.
Thank you, Sheila. Good morning, everybody. I'm excited to share understanding credit and provide some credit education and obviously answer some frequently asked questions. We get a lot of questions on how we can help you increase your credit score. So yeah, and thank you for the introduction, Sheila. Again, my name is Marisol Cortez, and let's dive right in onto the slide number 1. So what is credit? Credit is a measurement of financial responsibility. It'll include your current and past obligations and any loan that you have ever co-signed for, and also loans that you may be an authorized user for. So I get the question frequently. One of the most common questions is, Marisol, if I'm an authorized user on a credit card, will this help me establish credit? Or B, will it affect my credit if those payments are not made? So typically I answer when they ask me these questions is we kind of let you know that make sure you think long and hard before co-signing, and we'll talk a little bit more as we get into more slides in the presentation about that in particular. But in regards to the authorized user portion is basically, yes, it'll show on your credit report and it'll have it'll say that you're an authorized user on this credit card. However, on that credit card, if it's not paid on time or if there's something that happens, you most likely won't be impacted because you're not responsible for the credit card. But also to add to that, it doesn't help establish credit because again, you're not responsible to pay that obligation. So basically it's someone, brother, sister, husband, wife that allowed you to be an authorized user on that credit card. So this is a little bit about what credit is. And the next slide talks to you a little bit about how your credit score is calculated. So basically there's 3 different credit bureaus that you've heard of, I'm sure. So TransUnion, Equifax, Experian. Those are the 3 major credit bureaus that help determine the statistical model and assesses what your credit score is based upon what the creditors are telling them. Because keep in mind, the creditors are the ones reporting to these 3 major credit bureaus. And the credit scores range from anywhere from 300 points to 900. And in my past experience, I get the question all the time, Marisol, how can I get my credit score to 900? I've never seen a 900 credit score. I've seen an 880, but we're going to show you different tricks and tips on how to get your credit score as high as possible. So again, ranges are from 300 to 900. That's kind of like the broad, but we'll talk about what's more in the middle. Why is your credit important? There's obviously different reasons why your credit is important. And obviously it saves you money in the long run by getting the lowest interest rates by you having a high credit score. So anything that you have a really high credit score is going to help you save money when you're purchasing a home, when you're buying an auto loan. It's going to give you the best interest rate out there. And then you also have bargaining power. So you're able to see where you're going to get the best interest rate. But a lot of the times, aside from saving you money and getting you the best interest rates, we forget that there's 2 different areas that your credit is also looked at, and it's checked for, potential employment opportunities. An employer will look at your background check and they will do like a soft credit inquiry on your credit report and see how responsible you are as far as making your payments, and your credit history will show them how ethical and responsible you are for that potential employment. And then also rentals. So when you're looking to maybe rent a home or rent a apartment, credit is checked at that time. They definitely take a look and see, what type of renter they're getting themselves into, and they want to make sure that, there's no evictions or any other past obligations that were not in good standing. So it's really, really important that you keep your credit in good standing for different reasons. Another area that we talk about a little bit is insurance rates. A lot of the times people forget that when you're shopping for homeowners insurance, auto insurance, life insurance, any insurance policy that's going to help protect you and your assets, they're also doing a soft inquiry on your credit to see, again, how financially responsible you are and what kind of insurance premium they're going to offer you at that time. So these are 4 different reasons why having credit is very important, not only to save you money, but even maybe even help you get that employment opportunity to help you earn more money.
And then I'd like to add, if you remember a couple of weeks ago, we did a presentation about insurance. So if you want more details about how good credit or better credit can save you on insurance rates, definitely look back to about 2 weeks ago when we covered auto and homeowners insurance.
Thank you, Sheila. Good point. So this next slide here is going to show you why obviously good credit is very, very important, but mainly it kind of tells you this chart shows clearly how much it's going to cost you to have a lower credit score. So it gives you 2 different scenarios as far as a different interest rate in good credit standing and bad credit standing. So it's the same loan, $20,000. One of them is giving you an interest rate at 18%, and then the other one is giving you an interest of 3.25%. Now this is over a term of 60 months, so both are for 5 years. Over the term on the 18%, you end up paying a total of $10,472. And on the good credit standing one, you end up paying $1,696. You'll end up paying $8,000 more, a little over $8,000 more at the end, just by having a lower credit score than if you were protecting your credit and really making sure you were in good standing with every single creditor. So this is kind of just a little quick example on how it can negatively affect you in just one loan from different loans that we do every single year. So there's 5 key factors on your credit. One of them is your payment history. The other one is line availability. The other one is length of credit, accumulation of credit, and credit mix. So the next couple of slides, we're going to dive in on what percentages of each and every one makes up your credit score and how it can help you increase your credit score at your best ability. So we'll get into that next. So what is payment history? This is a big portion of how your credit score is calculated. 35% of your credit score is based upon your payment history. So basically making sure that you're making your monthly payments on time, that you're not late, and you're making sure, because a $10 or $20 payment can negatively impact you just the same as a $200 to $500 payment. Keep in mind that a payment missed is a payment missed, and it really can affect your credit. And not only that, it could take you up to 6 months to recover recover your credit score from making a late payment. So very important. One of the biggest ways to continue to keep your credit score very, very strong is continue to make your payments on time each and every single month, and make sure that you monitor every single aspect of your credit report. Because a lot of the times I've sat with our members and face to face, and they're telling me, oh, Marisol, this credit card, I thought I had paid it off, but there was a balance because of the interest rate or something that was charged and they didn't notice. And now there was a late fee because that payment wasn't made. So make sure that you're monitoring, especially when you're paying off credit cards, that you're paying off the full balance, including the interest. That way you're not negatively impacted by this. So again, 35% of your credit score is made up of your payment history. And then let's jump into line availability. So 30% of your credit score is made up of line availability. So amount of revolving credit, balances versus limits. And our best practice, and basically the rule of thumb that you hear, is you want to have 70% capacity and 30% utilization. And basically what that means to you is you basically want to make sure that if you have a total credit limit, let's say $50,000, that's your total, you might have 5 credit cards for $10,000, that you're only utilizing 30% of the total limit that you have available on your credit report. So you don't want to make sure that you're using 30% on each credit card. You want to make sure that as a total, the utilization stays either at or below 30%. I always recommend 30%. So that's kind of the capacity rule of thumb. You'll notice that if you ever have a line of credit maxed out or one of your credit cards gets maxed out, that's when you see your credit score get negatively affected and points start dropping as you go. So it's an important thing to keep an eye on your balances and also your limits, because a lot of the times we forget to take a look at what limits we have set on our credit cards.
And that's so true, because now that you say that, I realize like when I actually pay off a credit card, all of a sudden my score jumps 10 to 14 points. And just for paying off a small credit card. But especially, I think it's like you said, especially with the revolving lines of credit, right?
Yeah, exactly. I take a look at that all the time. I kind of keep a little chart and it helps me get, maximize my credit score. And I always tell my members, and they're like, oh, you're right. I was thinking, if I didn't have this credit card maxed out, but I had this one all available, then it wouldn't affect my credit score. But it's a total. So it's a total on your credit report. So that's one of the best points. Length of credit. So 15% of your credit score is based on the length of credit. So basically your oldest trade line and the average age of trades. The best example that I can use in this scenario is I get the question, Marisol, I opened up a credit card when I turned 18. I still have that credit card available, but I don't use it. Should I close it? Should I close the credit card? It all depends. No two credit reports are equal and they're not identical. Everybody has different scenarios. So I basically tell you at this time, if that's one of your oldest trade lines, it can negatively affect you because you're shortening your length of credit. You're shortening how long your credit's been established. But in addition, if you started establishing credit after that, little by little, and you were opening other cards, I'm sure there's other cards that you have that you are using that probably have the same age. So it all depends on your scenario, but 15% of your credit score is made up by the length of your credit establishing and also the average age. So basically you're not closing credit cards here and there and opening other ones. You want to make sure that there's a good average and there's a good length on your credit report. So this one's pretty simple, and we definitely discussed this one. The next slide we're going to discuss a little bit more about is accumulation of credit. So 10% of your credit score is made up of debt accumulation. So basically the number of credit inquiries that you've gotten in the last 12 to 18 months, and then open dates. So basically multiple inquiries for the same credit, for example, a mortgage or an auto loan. For the first 60 days, it doesn't, if you're shopping a mortgage or you're shopping an auto loan, and you have different creditors do a credit inquiry within the 60-day time frame, it doesn't impact your credit because they're looking at you as a rate shopper. The credit bureaus understand that a lot of borrowers are rate shopping and they're trying to get the best interest rate out in the market. What really affects you when you're doing multiple credit inquiries all at once is when you're looking into getting unsecured debt. So you're looking at credit cards, and in the last 12 to 18 months, they're going to look and see, has this consumer applied different times to open credit? And it kind of just makes it look like you're more vulnerable and you're opening up more revolving lines of credit in order to establish more debt. So this can affect your credit score by 10, your credit score is made up of 10% of how many inquiries you've had in the last 12 months. And I get this question every single day that I talk to my buyers. Are you pulling my credit? Is it going to affect my credit? And I always just say, well, in the last 12 to 18 months, how many times have you pulled your credit? Has it been multiple times? Has it been to establish more debt on a credit card? Or has it just been because you're simply rate shopping? And then that's when I can identify if this particular inquiry is going to affect your credit score. So this is a little bit about 10% of your accumulation of credit. And this brings up to a good point. So basically, I get the question all the time, what's the difference between a hard inquiry on your credit report and a soft inquiry on your credit report? So there's two different types. One of them will, a hard inquiry can affect you based on that 12 to 18 month rule we just talked about in the previous slide. So what it does, a soft inquiry is basically you're checking your own credit score. You're wanting to see where you currently stand. That wouldn't be a lender doing an inquiry so you can establish new credit. Another soft inquiry, we talked about it a little bit earlier in the presentation, where an employer does a background check for you and they check your credit score. That would be considered a soft inquiry. Credit card pre-qualification offer, which occurred without an application. I don't know if you get these in the mail from time to time, but basically saying, hey, congratulations, you've been approved for a $25,000 credit card. This is the lender basically telling you that they know that you are a very solid credit-worthy person and they are offering you one of their credit cards. You didn't initiate the application, which means your credit was just pulled through a soft inquiry.
Oh my God, that's so good to know. Because like you said, I get those daily and I'm wondering, are they pulling my credit, or, because it doesn't affect, because obviously I didn't initiate it. So it's good to know that. Thank you.
Yeah, no, I think that all the time. I'm like, oh, I hope I didn't run my credits, but no, it's a soft inquiry. So it doesn't negatively affect your credit. Another one is getting an insurance policy. So when you're looking for different insurance quotes, again, your premium is going to be affected by how credit worthy you are. So they're doing a soft inquiry on your credit report. And then last but not least, because this one I get questions all the time, when you're establishing cable, internet, or any type of utility account, it is considered a soft inquiry on your credit report. And I'll bring this up
considering COVID, right? I'm sorry. That's good to know considering COVID right now and everybody getting cable and Netflix and everything.
Yeah, they're checking your credit. They want to see how credit worthy you are. And then actually they'll tell you if you need to make a deposit if you're not credit worthy, or hey, you can establish as many accounts as you need because you're in good credit standing. So that's why they check they do a soft inquiry on your credit report. A lot of the times I get a question and they ask me, Marisol, if I open a cable or internet or utility account, will this help me establish credit? Should I put it in my teenage child's name that's going to be an adult soon and I'm trying to help establish credit? No, so a utility bill won't help you establish credit, but it can definitely affect your credit. If these payments are not made and the utility company is not receiving payments on time, I have seen horror stories where the utility company will do something on your credit report where it negatively impacts you. So you have to make sure that you're also making those payments on time. So I just brought up that little extra point on this, but let's move on. Yeah. Usually a hard credit pull would be if you're initiating an application. So you applied for a credit card, you applied for an auto loan, you initiated a mortgage application, you gave a lender your social security number because you want to apply for credit. So that at that point would be a hard credit inquiry where it can not negatively, but it'll affect your credit score. Anything that you apply for, basically. So that's a little bit on the hard inquiry versus soft credit pool. This is my favorite one. So credit mix determines 10% of your credit score. So a lot of the times what we refer to when we're talking about making sure you have a good mix of credit, we don't want you to just have all credit cards or just all installment loans. We want to make sure that you have a little bit of everything because this helps you make sure you're a well-rounded buyer, well-rounded borrower. You have a mortgage, you have an auto loan, you have a credit card. These are all different types of loans that are reported. So for example, a credit card is a revolving line of credit, meaning there's really no end date. You pay it as quick as you want to, and there's a minimum payment requirement. An installment loan is like an auto loan where you have an end date. Basically, you're gonna pay this car loan $500 a month for 5 years and you'll be done. That's something that you would call an installment loan, or that's a line that you call an installment loan. And of course, you want to make sure you have a good mix of both, because a lot of the times what happens is if you just have all credit cards, it looks like you're not paying down your debt and you're a more challenged credit individual. So we always want to make sure that you have a good mix of all credit, and you establish utilities and you get your cell phone plan. All of that helps you have a good mix of credit and make sure you keep your highest credit score possible by 10%. And then items that you really don't think that can impact you or will be on your credit report, but we have to discuss, it's really important that we know that they can negatively impact your credit score, and how long they stay on your credit report is really important as well. So negative information that can affect your credit would be like a civil judgment, or you get a tax lien, you're not making your taxes, so you're not paying your taxes, so there's a tax lien, collection accounts. For example, you didn't make a payment on a credit card, but it went to collections, and now you're working with a collection company to make those payments back. Foreclosures or short sales, you know, and anything with home related, that would be a home short sale or foreclosure. Chapter 13 bankruptcy or a Chapter 7 bankruptcy. That's kind of what negatively can impact your credit. And then on the right-hand side, you'll see how many years from file date. So for example, on a civil judgment, 7 years from the date it was filed, not necessarily from the day it started.
Okay. Oh, I'm so sorry. What's a sample of a civil judgment?
I'm sorry?
What's an example of a civil judgment? Like what?
A civil judgment could be like a lawsuit, or you had someone sue you and you earned repayment and that went, so that's an example of a civil judgment. Great question. Actually, we should discuss that. And obviously a tax lien, we know what a tax lien could be. It could be it's 7 years from the day it's been paid. So not necessarily from the day it was filed, but from the day it was paid. And then collection accounts, 7 years from the last activity date. So the last time that creditor reported you on the credit bureaus from that activity. And then
we actually got a question that popped up on social. What is the short sale?
A short sale, that's a great question. We're not seeing a whole lot of these right now, but I mean, from time to time we do see them. But a short sale is basically you owed a balance on your home and you paid it for less of what you purchased it for. Basically, it was sold for a lesser value than what you originally owed on the property. That's what a short sale is. They're not very, we would see them a lot, and then here and there we'll see a few, but great question. And then this kind of continues to explain the number of years from the date of discharge on a Chapter 13 bankruptcy or a Chapter 7 bankruptcy. So this is really good information to keep handy, because I get the question all the time, how long do these things stay on my credit report? So we're going to recap everything we just discussed. How to ensure you have the highest score possible. Make sure you're making your payments on time. That's a huge percentage. 35% of your credit score is made up of your payment history. Again, $10 miss, $200 miss, it's reported the same way. Pay down your credit cards. 30% of your balances will affect your credit. So if you notice that when you pay down your credit cards, your credit score shoots up, that's why. Want to make sure that you know exactly how much your balances are and how you can get to that 70-30 rule. Close credit cards. Make sure that if you have one that's very old and it's one of the oldest trade lines, that you really think hard before you close it. And make sure you use it annually. Use it for gas or a purchase you're going to make. And if you don't really want to owe a balance, just turn around and make that payment. That just make sure you keep it active and it doesn't automatically close on its own, because that happens from time to time as well.
And that actually answers one of our questions, because we got another question. Should I close my credit card when I pay it off? That kind of answers that.
Yeah, definitely. If it's one, it affects two different areas. So it affects your length of credit, and it also can affect your capacity. Because let's say that credit card gave you a balance of $5,000 and you only owed $100 and now you closed it. You're also affecting your capacity, your length of credit and capacity. So it can affect two different portions that make a big percentage of your credit score. Resist opening new accounts. So unless it's like for, it's maybe once a year or so on and so forth, make sure that it's really when you need it. Don't run your credit multiple times. Because that can really impact your credit score by 10%. And again, 15% of it is made up of length of credit. And last but not least, we talked a little bit about this. So move revolving debt into installment loans. I see this done every single day. Basically, let's say you owe a balance on your credit cards and you want to make sure you consolidate them. You can consolidate them into a personal loan. You can consolidate them into maybe refinancing your home and adding them to your balance. Make sure you have a good mix. That way you don't have a whole lot of the revolving debt. That'll make sure you get the highest credit score and you're in the green area of that side.
What I see a lot here in our younger members, can you go back one, Marisol?
Mm-hmm.
You had said resist opening new credit accounts. What I always tell our younger members and even our interns is be careful here, because this is when you go to Macy's or the jewelry store or DSW or some, like, if you open up a credit account, you get 20%, Nordstrom Rack, 20% off,
Yes.
and you don't have to pay for 3 months. Well, you keep opening all these credit lines up. Yeah, you don't have to pay for 3 months, or you get 20% off. But one, you may forget about it. You may accrue even more debt than you even remember, and so on and so on. So that first one, resist opening new credit accounts, especially when you're starting to build credit. Like I always say that for our younger members. So that's an excellent point.
Yeah, and you bring up a good point. You want to start off with your credit on the right foot. So you don't want to open all these credit cards at the very beginning and then later on say, oh, why did I open all these cards and now I have to pay them, and all because of a 20% or some sort of offer that they're giving you for opening a new credit card, because it can impact you because you're starting a lot of debt early on, and also you're doing multiple credit inquiries on your credit report so early on. So you bring up a really great point. And the truth about credit repair, this is a big one. You could do it on your own, or you can come and sit down with a rep here at Financial Partners, and we can do something called a credit review. Because a lot of the times I've heard members go to a credit repair agency and they get charged for something that really we can help you with, or you can kind of look and see how you can help yourself by using all these tricks and tips that we're giving you today. So make sure that you're able to pull a credit report every year on annualcreditreport.com. You're entitled to one free credit report annually. Make sure you pull that. Take a look at what's on there. Dispute any errors. You're able to go to the credit bureaus and dispute anything that may be incorrect on your credit report. So it's really important that we're doing that, and make sure that each agency defines their process. Consult with Equifax, TransUnion. You can go to them directly. And make sure you assess credit repair vendors properly to ensure that they have the ability and the history to help you, because a lot of times they're not successful.
Yeah, I'm so sorry, Marisol. Anytime somebody asks, we always tell our members this. Anytime some sort of agency asks for a certain amount, 5,000 upfront, and we'll erase all your bad credit, be very wary of stuff like that. And whether it's here at your credit union or any other credit union, we just say be careful. Like Marisol said, we do it for our members. We guide them and we give them, we go over their credit reports and stuff and tell them how to fix things for free. It's part of what we do for you. It's part of our job. So just be wary when you hear, for $5,000, I can erase all your bad credit. Or something. If it's too good to be true, it is.
Yeah, that is very true. And then obviously the biggest thing is, before you go into debt, think long and hard. Make sure that it's something that you need or you need to have. And then co-signing. I would recommend that before you co-sign for anybody, make sure you build a plan with them. Make sure they're responsible. The individual that you may be co-signing for, make sure that they have a plan in place that if a payment is not going to be made or a payment may be missed, they're able to inform you right away. Because as a co-signer, you get negatively affected if that payment is not made on time. So you have to make sure that you really process it prior to you co-signing for anybody. And then work out a budget. Make sure that your budget meets any credit that you're going to establish. So make sure you make more than minimum payments. That way you don't have a credit card that you're just making minimum payments to. And then shop around for financing, making sure that you get the best interest rates. Join a credit union. A credit union is always going to give you the best interest rates in town. And then know your credit score. So do that annual credit report pool, and just make sure that you are an empowered buyer. Make sure you're like, I'm sure my credit score is this, and I know what I'm able to afford. And then make sure you're pre-approved. So when you're out shopping, for that be a car or a home, make sure that you are pre-approved prior to you start your shopping, because you'll know how much you qualify for and you're not getting yourself in debt for more. And just again, annualcreditreport.com to get a free credit report. And then you can actually purchase a credit report from any of the credit bureaus. So Experian, Equifax, and TransUnion. Here's their information. You'll have a copy of this slide. That way you can directly go to them as well. And then if you're a member of Financial Partners, we can also help you by signing up with identity theft protection. So those are key points before you go into debt, what you can do. And then, especially because we're a credit union and we're discussing credit, it's important that we bring up other factors that we consider. So let's say, the credit is challenged a little bit. There can be different extenuating circumstances because, people's credit's not perfect and it's for different reasons. So there are other factors that we consider, like your income, your debt ratio, how long you've lived in your home, how long you've owned your home, how long you worked at your employer, and if you have assets or a retirement account that has a good amount of balance that can help us offset. So don't be weary. Don't say, oh, my credit score is not that strong, I might not qualify. It doesn't hurt to check and sit down and even do a credit review on how we can help you, increase your credit score, but also how we can help you borrow the money that you do need at that time. So don't be afraid to apply for credit if you really need to. And then after you sit down with a banker and let's say we helped you do a credit review and for whatever reason we can't help you, strengthen your credit, there's other agencies that we would recommend, and these are two of them. So you can, seek assistance outside of the credit union. So these are the two ones that we would recommend: Financial Counseling and National Foundation for Credit Counseling as well. So their information is on here as well. But check with us first, see what we could do for you first. And I've mentioned these a couple times along the way, free credit reviews. What's really cool about a credit review is you sit down with one of our very experienced bankers, premier banker, mortgage loan consultant, and we will sit down, assess your credit report, and we kind of give you tips on what you should do. Pay down this balance, maybe move it into a personal loan, or let's refinance your auto. Different tricks. I've helped several hundreds of members, have a stronger credit score. That way it gets them to their next goal, buying a home, buying a car. So these free credit reviews are awesome. And I always recommend one, especially if you have a thought like, oh, there's something that I may be doing wrong or something that I need help with on my credit. So stop on by and do that. And now we're going to open it up for questions. I hope this was really helpful. Thank you so much, Sheila, for having me, and we'll answer some questions.
Some of the questions we received via social media, one is, what is the ideal number of credit cards to carry?
The ideal number of credit cards to carry. So I don't think there's an ideal number of credit cards. My personal recommendation would at least say you have 3. So to make sure that you have enough capacity where you follow that 70-30 rule we talked about, where you're not using more than 30% of your available credit limit, but also just so you have options, MasterCard, Visa, different options. And then that way, when you're applying for other loans, you have at least 3 established trade lines. So my recommendation would be 3, but there's no ideal number of credit cards you should have. Great question.
Rate shop, because I've seen it where, like any credit union is usually lower. It's typically lower than, let's say, a bank and a department store credit cards, because the department store credit card national average right now is 29%. And while the credit union is below, at or about 10%, anywhere from, 8 to 12%. So, I mean, just do the math, right?
Yeah.
So, okay. I have one that says, I co-signed an auto loan for my son. When I tried to refinance my mortgage, I found out he has been paying it late and it hurt my credit score. What can I do to get that information removed?
So there's 2 key points to that question. To get the information removed, unfortunately, if you co-sign for someone and there was indeed a late payment, then you can't get that information removed per se. But what you can do is you can establish a system with your son or daughter, and make sure you're monitoring the payments on a monthly basis and making sure that they're made on time, but also make sure that they know when their payments are due, and you kind of establish a system. Hey, let's pay it 5 days sooner. That way you don't get into this predicament. Another thing is, now we're kind of in recovery mode. So if the payments were not made late, I would write to the credit bureau and say, hey, this payment was not made late. Let's go ahead and file a dispute. You can do that as well. or come into the credit union and sit down so we can do a credit review, so we can see exactly where you stand and how we can help you recover so you can refinance your mortgage, because that's an important piece that can help you save even more money as well. But now you're kind of stuck in a situation where we have to take a look in a little deeper and see why it was hurt so badly that you can't refinance.
Okay. Another question is, as far as my credit goes, is it better to pay back debts or save money first?
So pay back debt to make sure you're following that 70-30% capacity. So I would recommend you pay down your debt enough where you're at that under 30% utilization rule, and then continue to save money after that. So pay your debt off first to that 30% capacity. That way you get the highest credit score, and then start saving money for whatever goal you have, that be buy a home or whatever it is the reason you need to save money for.
And what I always advise my members as well, if I may add, is, if you have several credit cards and you pay a minimum on each, it makes it really difficult. And this is where something like a debt consolidation loan may come in. So whether it's a debt consolidation loan or putting everything on one credit card, then you have one payment a month that you can pay more on, versus if you pay, 3 or 4 separate credit cards or personal loans and you're paying the minimum, it'll take years to pay that off. So sometimes, again, speak to somebody like Marisol, a premier banking officer at one of our branches, because, whether it's with us or, again, some kind of debt consolidation, that goes a long way and pays it back faster.
Yeah, and if you ever look at your credit card statements, it kind of gives you a breakdown on there, and it tells you, hey, if you're only making your minimum payments, it's going to take you 10 years to pay off the credit card. And it's like, whoa, it kind of tells you, let's make more payments, or let's move it into an installment loan to help you get that paid off quickly or sooner.
Crazy. Sometimes a $2,000 credit card, balance can take 5 to 10 years because you're paying that little percentage. So, yeah. Okay. One more. I would like to buy a house soon. Oh, perfect person to talk to, Marisol. I would like to buy a house soon while interest rates are low, but my credit is about 600. What is the fastest way to improve a poor credit score quickly?
So the fastest way is run to our financial partner's office and sit down and let's look at your credit. Let's do a credit review and see why your credit score is there. First, we need to identify what's affecting your credit. So what's impacting you, and identify a solution from there. That be, if your credit cards are maxed out, we're going to recommend, okay, let's make sure we pay these down, or let's move it into an installment loan. Let's see what other assets you own. So there's different areas that we can do to help you recover. I would say recover. There's like I mentioned earlier, no 2 credit reports are identical. So I don't know what's affecting you directly, but let's identify what's affecting you first and then go from there. It's kind of the best answer I can give.
I'm thinking, yep, that was our last question for today. So thank you so much, Marisol. As you see, her phone number and her email are there. So if you have any questions, you can be contacted there, or you can call or walk into any of our branches and tell them you just need a free credit review or a free financial review. We can help you in whatever way we can. So join us again next month. Oh my goodness, it's already October. And we'll be doing more of these educational presentations. So we hope you enjoyed it today. And Marisol gave you a lot of great information. So thank you. Bye.